Welcome to Money Secrets with Bill and Mike.
I'm Bill Alexander.
And I'm Mike Tove. And you know, Bill, I had a client come into my office not very long ago. They had inherited a lot of money. It hadn't showed up yet, but it was coming. And
well, they were wise to seek advice before they received it. And I think that's, it's really important. I think that we need to talk about baby boomers who receive an inheritance and what to do with it, what not to do with it, you know, where people make mistakes.
Right. So we'll be right back in a minute, and we're going to talk about some of the good and the bad, and I guess the ugly, of inheriting money. Stay tuned. Welcome back. So you know what's interesting? I heard a statistic, it's an old one, that the vast majority of people that inherit money within, it was a banker's...
Well, there was a study.
19,
America Banking Association,
right,
about 25 years ago, did a study on inherited money.
Mm-hmm.
And that study showed that without regard to age, education, or financial wherewithal, that that most people lost or spent all of their money within 19 and a half months
right,
of receiving the inheritance.
And I have long maintained that they all spend it on the exact same thing.
Which
stuff.
Is, absolutely. And,
So
and
they
the bottom
get
line
stuff.
is they, you know, after it's gone, they don't have anything to show for it. And what is so sad is that for most people, that inheritance represents the one time in their life where they will actually receive a windfall. So it's an opportunity to get their ducks in a row. It's an opportunity to do something for themselves and their family if they just know what to do with it.
And the other piece to this that I find clients really don't appreciate is that there are a lot of misunderstandings about what the tax implications are or aren't for inherited money. Whether there's a step up in basis, whether it doesn't get a step up in basis because it is a tax deferred account. They think that if their estate is below the estate tax threshold, which they're uncertain what it is, that there's no tax consequences, and sometimes that's not true.
Let's talk about each one of those. First
right,
of all, for most people, there is no tax consequence of receiving an inheritance. Right now, the exemption in terms of estate tax is $5.49 million per person. Most of us are well below that. Hence, no estate tax, and in most states, no estate or inheritance tax, although that's going to vary from state to state. In North Carolina, clearly no estate tax for except those families of extreme wealth. Now, the step up in basis, what that basically means, if you inherit, say, some land or some stock, you are receiving that property at the date of death value. Most people couldn't tell you what their basis in property is, and when we say basis, we're talking about the acquisition value.
The
normally.
cost of when you acquired it.
Right, and most people don't have a clue what that is. So actually, date of death values helps a lot of families,
right,
and to the degree property is sold at that time, there's no income tax because your basis has gone up.
But be careful, because anything that is essentially a tax-deferred account, whether it's
right,
an IRA, 401k, 403b, or a deferred annuity,
right,
does not get a step up in basis.
Right, that's correct. And so that's, those are the two where, but you only are taxed on those when you actually take money out of it.
However, if you are not a spouse, there are legal requirements that those things must be liquidated.
Well, if yes, that is correct. And so, in fact, children of receiving an IRA actually have a lifetime minimum required distribution. So even if they inherited at 12 years old, they will have required minimum distributions from day one. And that
Right.
is important. Now, the other big asset that some people receive is life insurance. And in almost every case, there are exceptions, but in almost every case, life insurance is income tax free.
Correct.
And so those are some of the basic that are really important. There are a couple others that I think are really important. When you receive an inheritance, in North Carolina and in most states, that inheritance is non-marital property. So for those who are in a weak marriage, it might be important to keep your inheritance separate and not commingle it with marital property. Once it's commingled, then it becomes marital property, and if later there's a divorce, then the inherited property would be split.
Right.
But if it's kept separate, then it would not be split. It's non-marital property. So that's real
Right.
important for folks to understand as well when they receive an inheritance.
Well, that introduces a whole second tier of dynamic in the planning process, doesn't it? Because
It sure does.
when you go to a financial, and then we just did a show on this. When you go to a financial planner and you say, I'm inheriting all this money, what should I do with it? One of the first questions the financial planner should be asking is, what is your family status? Because if we're just going to take the inheritance and set it up in your typical joint account and blah, 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 and that relationship is not very strong, especially if there are previous marriages on the books and
Yeah,
all
children
the,
by separate
oh my God,
spouses.
yeah,
All of that plays into it. And of course, Mike, as you know, we do a lot of asset protection planning in my firm, and truthfully, there are two huge issues when it comes to protecting your inheritance. Number one is where most people who go through it lose a lot of property is in divorce. So that's a biggie. The other one is in scavengers. Who do you think those scavengers are most of the time?
disgruntled relatives?
No. It's children and grandchildren.
Yeah.
You know, the bottom line is really difficult for parents to say no to their children and grandchildren. But the bottom line is that when they know their parents have received a large inheritance or even a meager one, it's like, Mom, I need help. Help me fix the car, or help me with this or that, or it's.
I'm going to tell you a wonderful, fun story when we get back. Stay tuned. You're going to enjoy this. Hey, we're back. So I was about to say, there was a story that I heard. It was about a woman who remarried after her husband passed, and she changed her will to name the kids from her new husband's former family.
Not unusual.
And her children came to her very upset. And they confronted her about this, and they argued with her. And finally, she goes into the back bedroom. She comes out with the document, and she says, I'm sick and tired of this. If you feel that strongly, here, you can do with it what you want. And they took the will, and they threw it into the fire, and they burned it. Not that long after she passed. And when the will was opened, she had switched covers. The old will was in the new cover, which had been burned, and the new will was in the old cover, which existed. And they go to the judge and they say, but wait, that's not what happened. And the judge says, well, produce the original will. And they said, we can't. We burned it.
Of course. Well, that is a funny story. In fact, it was one of my colleagues who told that story.
Yes,
and,
I know.
It was something that we're both familiar with. And those kind of things do happen. But let's get back on topic here. So you've received an inheritance, and you don't want to be like most folks who lose it all within the first 2 years. So what are the things that you should do? Well, from my perspective, if you don't have at that point all your financial ducks in a row, at least the first thing I would say is pay off your debt, or at least most of it. Any kind of credit card debt,
Oh, yeah.
high interest debt, that should clearly be paid off. And as you and I have talked about,
Well, we call that good planning, and good stands for get out of debt.
Exactly.
So-
And actually, in most cases, at least for me, I would also advise my clients to pay off their mortgage if it's not.
Depending on individual circumstances.
Sure,
If they
always.
have income, the challenge with paying off a mortgage from a financial planning standpoint, and I understand and I agree that there are times when it makes sense, but the problem is that when you pay off a mortgage, because of the structure of the amortization schedule, all of the interest is paid in the front, and what is fundamentally left at the back end is principal. And so all you're doing is you're repaying principal and saving very little interest. And the question now is the time value of money. Could that money work harder for you than for the bank? And if it could, and if it is possible to get a bigger bang out of the buck, giving the money to the bank.
I don't disagree, and I would say yes if the person goes to a really good financial advisor who can make that happen for them and they make the right decisions with their money. But most folks aren't that good. And so as a general rule, I believe it's far easier for retirees when they're on a fixed income to have that mortgage paid off. It makes their money go so much farther, and I think that's really important. Now, the other thing, truthfully, as it relates, most retirees make mistakes as it relates to underestimating what they're going to need in retirement. You know, part of it is inflation. All you have to do is think back 20 years ago and what things cost 20 years ago. And
Well,
then
I'll
think
give you
ahead.
a better one than that, because I ask clients all this all the time. I say, what cost more, your first house or your last car?
That's correct.
And they go, my last car. And
Right.
then I say, I'm not done yet. Because 50 years ago, the average house in this country was just under $12,000. House.
Remember, yes, no, I understand that.
What does a good used, oh wait, they're not used, they're pre-owned, right? What does a good pre-owned car cost today?
well,
It's more than a house.
Well, the whole
50 years ago.
point is that inflation eats up fixed income. And so
Right.
obviously when you get an inheritance, being able to do something with it that is safe but also helps you with income through the future is really important and can be helpful. Of course, there are two other factors that go into just basic planning, and that is keeping the scavengers away, because that's the easiest way to lose your inheritance is by giving it to your children and grandchildren and it's not available to you anymore. But the other issue that's really big that's always underestimated is long-term care needs or
Right.
medical needs. The medical expenses, the cost of drugs, and particularly if you need assistance with activities of daily living. Most folks are just completely blown out of the water and shocked. So obviously if there's enough money and an opportunity to keep liquidity in place but also to have some long-term care protection, I think that's a wise use of money.
Well, this is where financial planning actually comes into place.
Well, we know every person's situation is different.
Right.
And so the real key is what's the starting point? How much is the inheritance and how well off were you before receiving the inheritance?
But see what happens, and I see this a lot, is that people will show up and they have assets, but they're afraid to use them because what if something bad happens? I had a client some years ago that had $2 2/3 million in the bank because they were afraid of an emergency. And I kept wondering, what kind of an emergency are you afraid of?
I have clients like that too, but I also have clients, and you do too, that have a high net worth but have a very low liquidity. They own a business, they own a lot of real estate.
Paper rich and money poor.
Right.
And so it all comes down to individual planning. That's the key. So stay tuned. We'll be right back in a few minutes and we'll kind of wrap this up with the money secret. Welcome back. So, we're talking about folks that inherit money, and I think the secret here is that when you inherit money, if you inherit money, that's an asset. And it should be handled the same as any other asset. It's not, you didn't win the lottery.
Well, it is an
It's-
important thing though, because it's, for many folks, it's their last opportunity to get their financial plans right, to get them in order. It gives them the opportunity to adjust, whether it's paying debt or investing properly for income, but it should be about asset protection, making sure, doing the right things legally and financially that allow them to keep control of their money.
Well, there's something else about this, and it's certainly not true every case, but I suspect it's true of an awful lot of them, is that you're inheriting money from your parents.
Mm-hmm.
And if you had a good family relationship and you receive what your parents spent their lives earning and accumulating and protecting, and you do silly things and blow it, how would they feel if they were looking down from on high or whatever?
Mm-hmm.
So you have, I think, the responsibility of being a good steward of the money that you receive from your family.
Right.
Planning is critical, just as it is with everything else.
Yes, and another secret, quite frankly, and this is sort of a no-brainer, but don't go borrowing money in anticipation of receiving
God,
an
yeah.
inheritance. That's one of the worst things you can possibly do. Wait until you receive your inheritance.
Right.
You could be talking to an advisor prior to receiving it so that
Well,
you have a game plan.
You should, because things
when
don't
it's
happen
received.
like that, and good planning sometimes takes a little time.
And oftentimes inheritance are not paid the next week. It might
No.
be the next year, might be a year and a half before,
Right.
or longer before you actually receive the bulk of your inheritance.
Of course, if there was good estate planning up front, then
Be quicker,
Yeah,
no question about it.
Right.
Probate
that was a
slows you
plug.
down. Yeah, there we go.
that was a plug.
No
But-
question about it. But the bottom line is, how do you protect yourself?
Right.
And quite frankly, sometimes the biggest culprits are your own family.
Oh, yeah.
So you have to do what you need to do to protect yourself first when you receive an inheritance.
Right.
And don't be like one of those that the Bankers Association said, it's all going to be gone in 19 and a half months.
And don't listen to people that want to jump in. See, that's the other thing, and we have said this over and over and over again, is that when whether it's an inheritance or whether it's the money that you've already had, if you go to a financial planner, you sit down with that person, and the first words out of their mouth is, oh, well, you got all this money, let's sell you a something.
Right.
That's product peddling. That's not planning.
Right. No, I agree. In fact, that's if you hear that from the folks you see, that's the time to leave.
Yeah, yes. So, but as a general rule, you know, we talk about being a good steward of money. We hear that, those of the people that like to go to church, and we hear that a lot. So, but the truth is that you are being a good steward of continuity of money. It comes from your parents, it comes to you. You're hopefully setting a good example for your kids, that one day you're going to have it too. You're going to be moving on, sorry. And what kind of an example do you set? You know, that's how I got into planning, is because my dad was so concerned with issues of planning.
Well, for another secret, if you will, is it's just a perspective, because in almost every case, your children and grandchildren are going to be asking you for assistance that if they knew that you didn't have this inheritance, they probably would not. And what I would say is that so many folks, the key thing is to be able to not run out of money themselves and not be a burden on their children because they have run out of money, because the children don't know when to stop in terms of asking for it. So you basically have to say, no, I'm going to put this aside to make sure I get through life without being a burden on you. And that is so important for folks.
So we're going to take a short break, and we'll be right back. Don't go away. Welcome back. So I'm Mike Tove of AIN Services. We do financial planning. We can be reached at 800-363-2296.
And I'm Bill Alexander of WG Alexander and Associates. We're attorneys who focus on estate planning, elder law, and asset protection. I would ask you to join me on Saturday mornings at 11 o'clock on WPTF, that's 680 AM, for my radio show, Asset Protection Today.
And join us next week when we have a very special guest. You don't want to miss this one.
I'm excited about it.
So am I. So see you next week. Take care. Thanks for watching.